So I'm Caroline Aumeran, head of Appygas, and I will be speaking about the role of transport capacities in today's European gas market. So from the standpoint rather of the TSOs. So maybe just a quick few words to begin with about actually Appygas. We are an innovation venture from Gas Deutschland, which started off in 2018. We offer a web platform, mostly myappygas.com, but also customized applications, which are delivering smart visualization of European gas market data in the form of portfolio network or market monitoring. So basically offering users a rapid glance at key fundamentals of the market using over 50 sources aggregated in real time. So going to today's topic and actually having a quick look at how and what changed in the transport business in the past 15 years. So really, the gas transport used to be a very physical business, infrastructure driven, dedicated to delivering and supplying, and through market developments such as liberalization, harmonization of frameworks, and the introduction and rising of the hubs, we have seen the development of the more commercial and I guess something to monetize aspect of gas transport capacities. So it has changed from the mere pressure-driven asset to also a price-driven asset. Taking a look at what has actually caused that change of paradigm in the market, there are two things that I would like to highlight. The first one is the end of predictability, so to say, versus flexibility, with 60% of long-term contracts set to expire by 2028, a trend which is just going on, as you can see from the ASOS market monitoring. So meaning a lot of volumes will be coming to short-term bookings, as indeed demand is expected, on the other hand, depending on the scenarios you take, but to remain more or less stable, hence opening those volumes to short-term markets. The second trend regards volatility. So we used, of course, to have a relative clear and might even venture to say simple supply picture in the sense of having mostly pipeline supply. And the rise of LNG has brought massive diversification to the European mix, leading to more volatility on the market. As most of you know and have seen also in the past weeks, there was a lot of a rally due to LNG being redirected to Asia and Europe being still mostly today more of a fallback market for LNG. So this brings volatility to supply. Additionally, we have seen the development of short-term transport capacities, so within-day products, day-ahead over-nominations, and together as well innovative storage products, so making infrastructure more fit to be an instrument to flexibility and to provide the market solutions for turnarounds. Last but not least, because infrastructure is still about security of supply and delivery, it means that whenever the unexpected happens, then you need to be able to guarantee, to be able to guarantee security of supply. And as Justin was mentioning in the introduction, such a cold snap that we experienced a couple of weeks ago pushed prices in Spain to records high and also led to a rush for pipeline supply and transport capacities accordingly. So just looking at actually a few figures based on last gas year's cross-border capacity bookings, we actually speaking about a volume of 5 billion euros and volumes that amount to more than 5,000 terawatt. So just again on cross-border capacities and excluding gas import points. And interestingly also, 35% of those capacities were booked via platforms, a volume which is, like I said, due to the ending of long-term contracts bound to increase. So meaning also there is an opportunity here through those platforms, of course, for increased digitization of activities, because this means harmonized products, this means data also available through the platforms to be leveraged, and the potential to automate process. So in the sense of also of what Route4Gas is doing, it can also be a trend that is providing, so to say, the foundation to new business models, such as the one of Route4Gas. And finally, moving to details on those transport capacities. So transport is still needed, but it will be different, or it is moving to something different. So it is moving to short-term capacity. So like I said, to make up for the expiry of long-term contracts. However, even on those short-term, there is still a clear preference and a vast majority of bookings which are performed for what I would call the new midterm, so yearly or quarterly product. So still also factoring in a bit of a stability and predictability that shippers are likely then later on to try to optimize on short-term, very short-term basis. And the second trend is that unbundled capacities will lead way to bundled capacities, which also provides more substantial ground for optimization. So volatile markets and short-term booking together do create a solid ground for arbitrage opportunities, but transport business being what it is, also physically based, that means also any unexpected event, even with short-term instruments, can lead to discrepancies in the portfolios that shippers have. So looking at what one can do, and the use cases that shippers may in fact be confronted with. So like I said, there is no perfect portfolio, there is no way to predict everything, particularly because also transport capacities are not built on a use it or lose it model. So how can you then leverage? In two cases, there is either the congestion, so a rush for capacities, and then if available at all, primary booking can get more expensive through surcharges on Prisma, or the need, the capacities that you have in your portfolio, which are not going to be used, which means the primary booking costs are actually sunk costs. This is mostly unbundled capacities. To the moment they stay, 99% of the capacities which was offered last year on Prisma secondary market was unbundled capacity. Or this is a capacity which is not in the money, so through which also very unlikely that any shipper will find use for them. So as TSO and as infrastructure operator, there are only really few instruments that are provided for flexibility once you're looking to optimize your primary bookings. So a basic, easy way would be to surrender capacity to the TSO, but this is neither really financially attractive, neither also very flexible in terms of you can do, since most of the time you only just give back the entire rest of the product, and then you have to hope that the TSO will be able to market those capacities again, so it's not very flexible. Or the second way is through Prisma secondary trading, which, like I said, is actually not very liquid. There were only last year 560 terawatt offered, and 10% of capacities booked on Prisma, which were in fact further traded on Prisma secondary. So all that results in, still to this day, relative limited liquidity, not very attractive conditions in terms of tools and instruments that TSOs can provide. But to conclude, it is also, in a way, not the role of the TSOs to necessarily provide all those instruments. They are providing first and foremost supply and delivery of gas and providing the infrastructure. So meaning there is only so much that we can do as TSO to help shippers optimize and monetize the flows. And to this end, the market has been very creative at designing solutions to bring these opportunities. Thank you.
Thank you, Caroline. Very nice presentation, very insightful. It's always nice to see market views with very good use of data in the presentation. So that was very nice. Thank you.